An earnings nightmare is coming. I'm your host, Steve Van Metre, and thanks for joining me today. And in our lead story today, investors are bracing for an earnings nightmare. And we talked about this on the Sunday show, how they're fleeing to cash in anticipation the stocks will tank. Meanwhile, Wall Street's up to its same old games as they brace for the same earnings nightmare, but with a twist to drive stocks higher. And in today's chart-packed show, we're going to look at why layoffs are likely to increase and why stocks can actually go higher. Let's over to the Wall Street Journal where we pick up the headline, Wall Street sets low bar for corporate earnings season. And I want you to get the first kind of words in this thing, sets a low bar. So what you have happen is analysts at these big banks, and their job is to sell stocks to people, to write research reports and get them to buy, and buy more. So what they do when they know earnings are going to be poor is they water down their estimates and say, look, we already knew it was going to be bad. So see, they beat our really watered down estimates, and look, everything's going to be okay. As you're going to see, it's Wall Street back to their same old games. Analysts expect companies in the S&P 500 to report their first year-over-year decline in quarterly earnings since the height of the COVID-19 pandemic in 2020. Fourth quarter profits are projected to have dropped 4.1%, a sharp reversal from more than 31% growth logged a year earlier. And this should come to no surprise to us because after massive amounts of fiscal and monetary stimulus, the withdrawal of both has to lead to lower earnings and profits. The question is this the beginning of the market heading off a cliff and earnings and profits going down more, or is Wall Street's trying to manufacture a bottom? Companies have been battling a host of challenges, including persistently elevated costs, rising interest rates, and once-in-a-generation surge in the dollar. And while analysts have been trimming their earnings expectations, there you go, investors are looking at this next round of reports for insights in the resilience of corporate profits and the outlook for stocks. And actually what we see here, at least from retail investors, is they believe this is going to get worse and a lot worse. And what I'm trying to suggest is with Wall Street up to its same old games, maybe they're trying to price in this downturn and pull everyone back into a monster rally before, as we know, the yield curve will trigger a huge recession. And that's the likely case here. But remember, Wall Street's got to offload all their stocks onto the public. But let's put this to the test. They talk about inflation and the dollar. Well, do those really matter for profits? And the answer is they do. Here you can see corporate profits after tax in blue against the nominal broad U.S. dollar index. And what we can note is the corporate profits on a year-over-year rate of change. And of course, the experts say this is headed negative, and they actually are right. This is likely to head down. But notably, what you can see the dollar here, during periods of a rising dollar, it is bearish for earnings and profits. So you can see dollar rising again here in 2012 to 2015, and it put a damper on corporate earnings or profits. They were relatively flat. You can see here starting in 2018 into 2020, the dollar went on a tear, corporate profits again flat, and then tailing off slightly negative. But how about consumer prices? Yeah, they were a big factor too. And here now we take corporate profits in blue, again, also on a year-over-year rate of change, and overlay the consumer price index in red, it too on a year-over-year rate of change. And what I want to point out is very normal for periods of high inflation. You can see here the consumer price index being elevated. You'll notice the corporate profits go down. Here you see again the CPI go high, and of course profits go down. And so we see this relationship over and over. Now more recently, you see it happen again. So there's two cases and two ways I want you to kind of interpret these charts. First of all, we know the dollar is starting to weaken here, and that's actually a positive sign. And of course, we know analysts and banks are looking at the dollar saying, hey, if it continues to weaken, that should actually be supportive for profits. But how about the consumer price index? While most retail investors believe inflation is going to stay hot, of course, we know the yield curve tells us inflation is going to come down. Let's go back and look at that chart again, because what it's telling us here is in periods where inflation starts to cool off. Again, we're going back to the 70s and 80s periods of high inflation. Notably, what happened is profits eventually rebounded. You'll notice in the 70s rather quickly. In the 80s, it took a little while, but it eventually did. So periods of high inflation, once it peaks and comes down, you can again see it during the great financial crisis, profits rebound. So all you're seeing Wall Street here doing is taking a big bet that perhaps we have seen the bear market bottom, and if the dollar weakens and inflation comes down, well, corporate profits over the next year or this year actually may look pretty good. Investors are starting to feel that we're headed into a recession, and that's a key point because we note that investors continue to race to cash. The question is what's different between a soft landing and a hard landing and what that may look like. Well, the real simple as a soft landing is just a slowdown in the economy. Maybe the market's already priced that in. Now, a hard landing on the other side would be more like the dot-com bubble bursting or the great financial crisis where things blow up and next thing you know, everything is crashing. And we can see investors are positioning for the hard landing, but at least from the economy standpoint, when we look at the data, it doesn't say that's happening in the near-term future. Now, it doesn't mean it can't happen. It just means there's nothing to suggest it yet. But we do see some leading indicators from the yield curve that a recession is indeed coming, but we can't look at that alone and say, are we going to have an all-out crisis or are we just going to have a slowdown? The S&P 500 declined 19% in 2022, but started 2023 on a brighter note, rising 1.4% this past week after a lighter than expected wage growth reading in Friday's job reports suggested inflation is abating, of course that being good for stocks. And here is the case that Wall Street's looking at. Now we've got again that corporate profits against the Wilshire 5000, the total U.S. stock market, that in red, both on a year-over-year rate of change. And we can see here, after the dot-com bubble burst, the market really had priced in a decline in corporate profits, and then they rallied higher. You can see it at the bottom of the great financial crisis. You can see other periods where the stock market, the red line being below the black line, was really pricing in an earnings recession. And I think that's what Wall Street's here is looking at. And they're saying, look, we're likely already experiencing this recession. The market's already priced it in. We know that corporate profits are going to come down, but if the dollar goes down and inflation comes down, well, then this is likely the bottom. Maybe we get another quarter of kind of bad results, but after that, it should start to look good. And of course, as we talked about on the Sunday show, when you look at machine positioning and you see momentum in the markets turning higher, well, it starts to stack on each other. And next thing you know, you get a burst in prices. And as we note from the CTA-Timer report today, I am going to start recording the videos on how to do it, how it works. Everyone's been waiting for that. Once they're done, the price for new subscribers goes up. But here you can see today alone, the S&P 500, they're buying. The machines and the fast signals would be buying today. And watch for the NASDAQ one to flip in tomorrow's report. It's coming soon. And that's how you can tell when a position is deeply negative and you start to get a counter rally. What you'll see is the machines start to follow. What's great about that report is it helps you figure it out, and it's $20, 30-day money back guarantee. Investors will reveal quarterly results this week from some of the country's biggest banks, including JP Morgan and B of A, as well as companies such as Delta and United Health. They will also parse the latest consumer price reading, which is probably the biggest data point coming this week, which is likely to influence the pace of the Federal Reserve's campaign. And let's take a look at what's going on with the banks. Now, in this chart we're going to look at here, we don't have bank earnings. We can't split that out, and we can't look at bank profits. But what I want to do is look at what happens to corporate profits when banks tighten lending standards. Now, as you remember from prior shows when we've talked about lending standards, when banks tighten them, it makes it more difficult for borrowers to get loans. And that means less money is created in the economy, and it has a natural effect of slowing the economy down. So what we should see, at least what I predict here, is that as banks tighten lending standards, we should see corporate profits fall. And sure enough, we see that exactly happening. Here you can see the red line, the net percentage of domestic banks tightening standards for commercial industrial loans to mid and large companies. And you notice as they tighten standards, you can see that, of course, profits are start to slow and trend lower. Here you can see now they're still easing on net here, but they're not as easy. You see standards are not as easy. Notice how profits start to come down. As standards tighten, profits head lower. Here we're seeing it again. And so what this tells us is that for bank earnings, it means they are likely to be disappointing. So we kind of already have a hunch that, of course, we're going to see the fourth quarter earnings be rather disappointing, and it should be broad-based. But watch for the CEOs to turn up the heat on next year, saying, hey, maybe the first quarter will be ugly, but after that, we're looking for things to be good. We expect continued layoff announcements probably spreading beyond the tech sector, and I totally agree with this, and I'm going to show you that falling earnings, not good for employment. Here you can see corporate profits after tax now overlaid with a 4-week moving average of initial claims, and we can note in periods where profits are heading lower and are expected to head lower, eventually claims start to rise. You can see it going into the recessions as profits on a year-over-year rate of change fall, that eventually you start to see an increase in layoffs. Now, it doesn't mean there's going to be a massive surge in layoffs. It just means you're going to see companies trim, and we saw that in the news today from Goldman. As Goldman to cut about 3,200 jobs this week after cost review, but let's put some color to this because Goldman, when we look at this chart here, hired a bunch of people. And this is kind of what I've mentioned and what Jeff Snyder and I, our chief strategist, have talked about on his channel, Eurodollar University, on the weekends when I go visit him, is that companies hired up tons of people and now they're going to trim a little bit. If, of course, we see a protracted downturn, they'll trim more. But notably, I want you to see on this chart, Goldman hired a whole bunch of people, so they're just trimming off a little bit of the top right now. And falling profits run the risk for making stocks appear more expensive relative to companies' profits moving forward. Companies in the S&P 500 are trading around 17 times their projected earnings over the next 12 months, roughly in line with the 12-year average. And again, now you start to get the Wall Street game. We're going to water down our earnings expectations. We're going to pump in and buy stocks. We know the machines are going to play chase. And why are we doing this? Because we're at the long-term averages. We see the dollar falling. We're not worried about that. We're actually happy about that. We're seeing inflation come down. That's good. We think the economy can handle these additional layoffs, and we don't think they're going to be big. So now you get the idea how the market is positioning into the early part of this year and into the summer. You expect that rally that we've kind of mentioned in previous shows, because now you're seeing this whole earnings game is going to be Wall Street playing their same tune over and over again while retail investors hide in cash. And with that, I'm Steve Van Meter. Thanks for watching. Thanks for being fans. Bye now.